Good evening from Beijing. Welcome to this special edition of 2022 Economic Prospects live on CGTN. I'm Kate Quay. We ended 2021 with uneven economic recovery, unequal access to vaccines, widening income losses, and divergence in learning. COVID-19 has had a disproportionate impact on the poor and vulnerable in 2021. It is causing reversals in development and is dealing a setback to efforts and end extreme poverty and reduce inequality. In the meantime, we face unprecedented inflation and surging commodity prices. The U.S. inflation rate is hitting record highs, with the U.S. tapering and China now facing domestic economic growth pressure and slowing down. How should we get prepared for the new year? And practically, how should investors allocate their assets? So today we kick off our 2022 Economic Prospects Dialogue Series. We are very honored to have today Dr. Gao Bing to discuss and share with us his 2022 World Economic Outlook. Gao Bing is the CEO of Kaifeng Investment Hong Kong and Chief Economist of Kaifeng Investment, a multi-billion US dollar macro hedge fund. A veteran capital markets player himself, he is also a special term professor of PBC School of Finance at Tsinghua University. So, Dr. Gao, very honored to have you and great to hear from you again.
Thanks for having me, Kate.
Great. Dr. Gao, if you look at the Chinese economic data released by the Statistics Bureau yesterday, on top of that 8.1 GDP growth rate, there's a 4% number, which was the Q4 GDP growth, made the highlights. So how should we understand this 4%?
Okay, I think a lot of people are worried about the 4% number because on a year-on-year, it looks really bad. However, because of the pandemics last year, it really distorted the whole picture. Right? Right. If you look at the whole year of 2021 versus 2020, the economy actually grew at 8.1%. That's way above of what the NPC was saying back in March. The government was thinking that anything above 6% is all right. And so 2021 definitely saw a number which is above 6%. Yeah, I mean, 4% itself is low. And if we want to have a meaningful growth in the year of 2022, and we need to do something, the government need to do something. And that's why I think we see the rate cut yesterday and also Deputy Governor of PBOC today came out and said a lot about what they are going to do.
Right. It seems you're still content with that 4% number. You think, we do not really need to worry too much about it. However, on top of those data, there are three terms caught my eye. They are a supply shock, weakening expectations, and also a shrinking demand. How should we understand these three terms?
Yeah, I mean, what I was saying was that if you look at the whole year growth, it's okay. And 4% is nothing to really panic about. It's not a strong number, but it was also well in the expectation. Right? And the weakening demand is something the government wants to address. And we have to understand the 4% in the context of why we got here. In the sense that that's what I would say the government wanted. They didn't want to have an overheated economic growth this year. That's why overall, in the beginning of the year, especially in the second quarter, the policy was relatively on the tight side. Right? If we compare the China policy versus policy in other areas, in other economies, they all have a negative real interest rate, where China has a really high positive real interest rate. Right. And it's inevitable the economy would slow down somewhat. And in a sense, that's what the government wanted. And I guess that's now slowing down a little bit too much, and they want to reverse the course and bring up the growth a little bit.
Right. Well, that makes sense. Can I just also understand what you said by you're basically saying that Chinese government are still having a lot of room as long as they want to do the monetary ease, because Chinese government are controlling the inflation well enough, comparing what U.S. is experiencing now.
Oh yeah, definitely. If you look back at 2021, it was a remarkable year. Remarkable in the sense that by being prudent, by being prudent on the monetary policy side, China has saved a lot of room in terms of the for the future if they want to stimulate the economy. So we have to separate these two issues, right? Everyone wants to have, in general, government wants to have a fast economic growth, but you can't continue to get it without some sad effect or the bad things happening. So when the economy is growing fast, China tightened monetary policy and maintained the prudent monetary policy. So now they have rooms. And I give you an example, like what do I mean by they have a lot of rooms? And everybody knows that China's interest rate is the highest among the major economies. And even after they cut interest rate, the 7-day repo rate is still 2.1%. And the 1-year MLF rate was much higher, it's close to 3%. Right? That's why that gives them a lot of room to cut if they want. And then the triple R. The deputy governor was saying something like, the room to cut the triple R is more limited than it used to be. And that's true. However, they still have more than 8% of required reserve, which they can cut as well.
Well, you mentioned. Sorry to interrupt you. You mentioned the reserve rate, the savings reserve rate, which is very interesting. PBOC just had its press conference this morning. Current deposit reserve rate is about 8.4%. Well, the spokesperson on one hand is saying that probably we should take some action as soon as possible. On the other hand, he is also saying that 8.4% doesn't really give us enough or too much room to move forward in terms of easing monetary policy.
Yeah, that's true, but. There's still, number one, there's still room to cut, right? And that's not even resort to balance sheet expansion. And now, given what happened since 2008, look at the US, look at Europe, you look at Japan, they all resort to central bank balance sheet expansion. Right? That's what I mean. China did a remarkable job in 2021. And by one measure, the China's central bank balance sheet divided by the GDP is lower than the Federal Reserve now. China has a central bank balance sheet which is 36% of the China's GDP. Well, the Federal Reserve has 39%. Then you look at the ECB, which is 70%. Then you look at Bank of Japan, which is 130%. So that means even if China runs out of room to cut the required reserve, they still have a lot of room to expand the balance sheet if they want. I want to be very careful here.
So are you saying? So are you saying actually, the next step for Chinese PBOC is to ease its monetary policy, and that's something for sure going forward?
Not necessarily, though. I'm actually quite ambivalent about what the PBOC is going to do, in the sense that if you look at the way the PBOC managed the economy since 2013, it's very interesting, right? And the real interest rate has always been positive. It's much more positive than all the other economies. They were doing that for a reason. They were doing that to try to deleverage the economy. So from here, I do think that they will ease the monetary policy. However, the economy is finding some footing on its own from third quarter to fourth quarter by the recent easing and some targeted easing early on. If the economy found a bottom started picking up on its own by the first quarter of next year, then I think people actually stop. And they don't want to overstimulate the economy. They just want to provide enough support so the growth does not fall through the floor.
Right, fair enough. You mentioned a very interesting year, which is 2013, which brought me to think about the cycle that we experienced before, from 2014 to 2018. It seems that we had seen the movie before. When US is tapering, China needs to react because all the global economy is connected. So how do you think Chinese currency or Chinese capital markets is going to respond to US tapering, which is happening right now?
Yeah, as you know that we've discussed about this issue in the past, and I've been very bullish on RMB.
Right.
And in the medium term, I'm still quite bullish on RMB. I think there's the very strong fundamental support for the currency, and from the manufacturing side, you see the China export continues to grow above all expectations. If you look at the value added in the manufacturing sector, China alone accounts as much as the US, Japan, and Germany combined. That forms the foundation for the RMB. Right. I do think in the very near term, and the US, the Federal Reserve will hike interest rate more aggressively than the market anticipates, and that puts a little pressure on the RMB. But I don't think it will weaken much, and especially it might not even worth betting on its depreciation because the RMB offers a higher interest rate, right? The spot exchange rate may depreciate a little bit, but it will be compensated with a high interest rate. So overall, I don't see much depreciation of the RMB itself.
Right, so that's probably something very different from the last cycle between 2014 to 2018, because we do see RMB currency rate against US dollar fluctuated a lot during that period.
That's right, and there's a reason for that. It's really interesting if we revisit that period and also look at the fundamental of the RMB. And from 2014 to like 2018, 2019, right? If you look at the fundamental of Chinese economy, there's nothing wrong with it. Right? China continued to grow faster than the US during that period. China's interest rate is higher than that of the US. China's export China continued to gather a lot of export trade surplus, right? So those were all fundamental reasons support RMB. Then we have to understand why did the RMB depreciate during that period of time. I think that the reason being that it's kind of interesting that I want to put it very clearly that keep in mind that when this administration came in and they started this anti-corruption campaign, right? Right. The anti-corruption campaign is very interesting. It's very good for China in the long term because a corrupted system cannot last very long, right? So that's good for the China system. However, in that very moment, there are a lot of people who are concerned about whether their asset was safe or not. So over the last 30 years, Chinese citizens have accumulated a tremendous amount of wealth. Right. So with that uncertainty, some money started leaving the country, right? That weakened the currency. And that's only one side of the flow, right? That's one side of the flow because everybody talks, everyone in China talks to each other and say, oh, I want to take money out, and you want to take money out. And you only talk to those people who want to take money out. You don't see foreigners who are really underweighted in Chinese assets. And that's the flow we are seeing right now. Right? So if you look at the last couple of years, and there's a lot of foreigners who are buying Chinese bonds, who are buying Chinese equities. And last year, and we saw a lot of that inflow as well. So it's a balance. Right, I think that most of outflow has been done through 2014 to 2018, and the inflow has just started. Right? So that's the flow which will drive RMB higher with the strong fundamental support.
Right, that makes sense. If we look at last year's GDP growth, I noticed a very interesting point is that consumption expenditure actually are contributing more to the GDP total composition comparing to previous years. I'll give you the number. In Q4 2021, consumption expenditure contributed about 65% to the GDP, while a year ago, the number was 54.3%. So how should we look at this composition of GDP going forward? Does that mean service industry is going to take a less important role going forward?
The old growth model in China has generally was related to investment, right, a long time ago. And so whenever the economy was weak, China tends to start investing and by the government, and then when they loosen the monetary policy, the real estate investment picks up. And that tends to be the factor which saves the economy. But since 2013, things have started changing because China started focusing on more what they called, they want to change course from the high-speed growth to high-quality development.
Right.
So the high-quality development that we think about the economy ultimately is about people's consumption. Right? Why do you want to invest? You want to enhance your citizens' living standard and increase their quality of life.
Right.
And those qualities have to be reflected through the consumption of consumers and the individuals and households. Right? And so I think that we continue to move toward that direction in the future, especially this year. I mean, last year there were pandemics which kind of hampered the consumption somewhat. You have the lockdowns, and you have the some sectors which laid off some people, and so the income was relatively on the weak side.
Right.
But this year, to stimulate the economy, and there's already the government started moving toward that direction, trying to help people to consume. And the recent rate cut, I mean, they cut the MLF by 10 basis points yesterday, and I would expect that they will cut the 5-year LPR by 5 to 10 basis points on Thursday.
Right.
And that cut will give back more money to the mortgage borrowers because the mortgage rate is linked to the LPR.
Right. The reason I'm asking this question is partially linked to the housing price and the housing market, because previously buying house or the real estate sector contributed a lot to China's GDP. How would you view this composition going forward while Chinese government to a certain extent is trying to cool down this sector?
Yeah, this is something I'm a little bit worried about. And in general, I agree with the government policy. Whether I agree or not doesn't really matter because I'm a practitioner. I take what I was given and try to find the investment opportunities. But I do see that the government has a point that continued rising of housing prices is becoming more negative to the economy than positive to the economy on balance. So I would think that they will continue on that deleverage path. And that's why last year they used a lot of measures and used tight monetary policy and also administrative measures to address the leverage issue in the property sector.
So I think this trend will continue.
I think the trend will continue. Does not mean they don't turn in the short term.
Right.
I mean, the thing I'm worried about is that since we see the property sector problem started showing off in the middle of last year, we are more than 6 months into it already, right? And that's I think the government is a little bit worried as well that once the expectation, the total change, once the consumers and the household totally changes their expectation on the housing sector and becomes very negative on it, then it's very difficult to jumpstart the sector. Right? You want to deal with it for the long-term purpose, but you don't want to go off a cliff. Right. Because once it start dropping fast, it takes a lot of a reversal.
But it seems it's unavoidable.
To arrest the problem. I think that it's still okay. I mean, at this stage, I think the government finally I mean, the government was sending signals over the last month or so, but today seems to be the day that they are sending very strong signals that they want to arrest the slide of the economy and including real estate sectors.
Right. So you think all the bubbles on the property market are really squeezed out through all those signals and previous several rounds of government actions, or you think there are still bubbles on the market that will potentially bring repercussions?
I mean, Greenspan once said that it's very difficult to identify a bubble, right? I can disagree with him. I think that you can identify a bubble, just it's very difficult to know when it bursts, right? We know. I would venture out to say the U.S. stock is in the bubble,
right.
And I would also venture out the JGB and also the German government bond are all in the bubble territory,
right?
And I'll also say there are some bubbles in the Chinese real estate sector, and however. I think there's still a good chance China will be able to engineer a so-called soft landing. Right? When the bubble is really big, it's very hard to address. But China's bubble, housing is expensive, right?
Right.
Relative to income. However, if you compare that one to housing prices in other countries, even compared to Bombay or Mumbai in India or Moscow in Russia, right? The absolute price is not that bubbly. It's nothing compared. Some people compare that with the Japanese bubble in 1989, 1990, and that's totally off. You cannot compare China's housing price to the housing price in 1989, 1990 in Japan, and that was the absolute bubble. So there's some bubble, but I think China will still be able to disinflate that bubble and manage a soft landing. So I'm hopeful here.
Right. You mentioned a very interesting thing. You said that U.S. market currently, in your view, is having bubble to a certain extent. So can you give us your outlook for the equity markets globally in 2022?
Okay. So in our outlook, we venture out to say that in 2022, we really want to buy cheap. Buy cheap meaning that we are quite happy to bottom fish in the stocks in Hong Kong. And the PB is less than 1, and the PE is about 9 to 10, and you can't find a cheaper market than Hong Kong, which the growth will be based on China. And it's still one of the fastest growing major economy in the world.
Right.
And discount rate is based in the US, and that's very low, right? So you put these two things together, the valuation does not really make sense.
Right.
However, it's been cheap. We understand that it's been cheap for a while. And what changes in Hong Kong this year? I think what changes that the politically becomes much more stable than a few years ago, and that's a good news. And the other thing is that I think that in the next couple of months, it's more likely Hong Kong will open up its stores with the mainland, and that will provide a boost in terms of sentiment.
Right.
And don't forget that this year, we will see the 25th anniversary of Hong Kong returning to mainland China, and that's something will also boost sentiment. And then with the new, chief executive coming in March, and with the new LegCo, I think together they will be able to get things done in Hong Kong, and that's why we're optimistic about Hong Kong this year.
Right.
And the reverse.
Sorry, go ahead.
The other side of it, I think that you are. I guess you want to ask about the U.S. and whether it's bubbly or whether it will go down or not. And
you mentioned U.S. is bubbly. That's why I followed up with the question. You said the U.S. market is relatively bubbly. Right. It seems that we lost our guest on Zoom. So let's just wait for him a little bit. What you're watching now is live on CGTN. This is our special edition of 2022 Economic Prospects. And my guest today in Zoom is Professor Gao Bing, who is the CEO of Kaifeng Investment Hong Kong. And he is also the chief economist of Kaifeng Investment, which is a multi-billion US dollar hedge fund. Gao Bing himself is also a veteran capital markets player. He is also a special term professor of PBC School of Finance at Tsinghua University. Well, today I'm going to talk to him on his outlook of 2022 world economy. And during the past 30 minutes, he gave us his view on the monetary policy outlook in China for the year ahead. And also, he's analyzing the equity markets globally. He was just talking about his view of the Hong Kong market, as well as whether US market is bubbly or not. And then I think we're going to reconnect him on Zoom very soon. One thing that he mentioned very interesting that I want to paraphrase again is that he thinks that Chinese economy, even though in Q4 we only have about 4% economic growth, in his view is actually a measured growth. By no means it means that Chinese economic growth is going to slow down. And on the contrary, it also shows that we are going to have a lot of rooms in the future if we want to further ease our monetary policy. So that is his view. Well, I also asked him how should we compare this round of monetary policy easing with the 2014 to 2018 period, and he said there are a lot of similarities. However, in his view, the RMB depreciation is probably avoidable because the economic situation is very different now. Now we have Gao Bing back. So Gao Bing, can you hear me again?
Yeah, I can hear you.
Okay, let's continue our dialogue on the bubbly U.S. markets. You were just saying that U.S. market is bubbly, and then we lost you. Please go ahead.
Yeah, well, as we are discussing, I think the U.S. market is selling off today, but nevertheless, I see it this way, actually. In our investment outlook, we discussed that there are three major themes. One of them is called what do we call DM to EM rotation.
Right.
The DM to EM rotation was that over the last few years, the DM printed a lot of money, and the EM did not have the luxury to print as much as the DM countries. Right? And so the DM printed money a lot of them went to the stock market and send the stock valuation to a stratosphere. And now the central bank, given the inflation, the Federal Reserve will start raising interest rate, and they have signaled that, and it looks like March is very likely to happen. And in our investment theme, in that DM to EM thing, we figure that we have to have the inflation first before the central banks of the DMs will raise interest rate.
Right.
And now last year, what we got was a commodity price inflation, which was really high. And then that lifted the inflation. That inflation will get the central bank to start working. And once they start to raise the interest rate, and then the bond rate will go up. And then that will hurt the stock valuations, and the stock will still go down. However, I do want to caution everyone that I don't see the stock market, the U.S. stock market, started dropping immediately, because the old habit never die, and the investors today have never seen, well, generally the major investors and most investment professionals in their 30s, even in their 40s, did not see a major stock correction. They have never seen a really hawkish Fed either, right? So their habit was to buy stocks whenever they go down. So we will see volatility start picking up first, and that drop, and they buy and go up again. And we are likely to see a major problem in the toward the end of second quarter or second half of the year, when the Federal Reserve really started to run off their balance sheet. And then that's when we see the liquidity really drying up, and that will be more headwind for the U.S. equity market.
So basically, you're just saying, let me summarize, is that Hong Kong market is undervalued. That's probably we can bottom fish, or where we can bottom fish. Well, in your view, the U.S. market is a little bit overheated. And then with the tapering process, in the second quarter, we might need to we might need to be a little bit cautious in terms of valuation, so on and so forth. On the other hand, I think U.S. economy is also catching up. Currently, the PE ratio is relatively high for the U.S. market. Do you think actually the economic recovery from the U.S. side can actually, brings the earnings back to the market and offset a high PE?
I don't think that I will support the high that kind of a high PE.
Okay.
I mean, the growth is good. I mean, I have to say that we know that the U.S. economy currently is on the strong side, and the IMF predicts that the U.S. economy will grow at 5.2% and China will grow at 5.6%. But then that's when things become interesting, right? And you had the U.S. valuation was extremely high. And yes, the growth will still be strong. I think 5.2% for the U.S. this year is high, but I don't know, it's but it will still continue. It will still grow at a reasonable speed, maybe about 4%, and but it's still lower than that of China, right? And so, how do you justify a market which is at a very high valuation, where the growth is lower than Hong Kong? I mean, the Hong Kong companies are based on the China growth, right? And then the interest rates are going up. Right? So I don't think that growth alone will be able to continue to support the U.S. market to go up. And I think that it will likely go down. I'm more bearish on the U.S. market. And also, there's another anecdotal point, which is also interesting. If you look at the past, the major Fed hike cycles, in 1994, in the year before, in 1999, and in 2004 to 2007, and then again the last hike cycle. For all those 4 cycles, for 3 of them, during the hike cycle, the Hong Kong shares go up in absolute terms and also outperforms that of the S&P 500.
Right.
And that's a fact.
Right.
Yeah.
But according to your logic, you're basically saying that Chinese companies are riding the strong economic growth of China domestically. They should enjoy a higher PE. The trend actually should have started about half a year ago, because Chinese economy started recovery, very aggressively in the second quarter last year. Why market didn't really recognize the value of those stocks and let it undervalue for so long, especially in the Hong Kong market? Well, on the other hand, Asian market, especially the green energy sector, actually valuations are very aggressive. How should we look at that sector going forward? Well, because in your view, those stocks, those sectors are actually similar as what U.S. experiencing now. The PEs are, at about 100 level.
Yeah, that's what I said early on. That one of the things we constantly talk about last year was the politics is the biggest macro, or we can play politics rule over macro, right? And if you look at Hong Kong, it's really unfortunate. 4 years now. In 2018, when the U.S. started trade war with China, and Hong Kong was at the forefront. Right. Then 2019, you have this unrest, and then 2020, you have this pandemic, which locked down the city and leave the city isolated up until now. Right. So there is no good news in Hong Kong. So there's a really there's nothing positive to talk about for
a catalyst, basically, for the market. Yeah.
Right. And now, I live in Hong Kong, and I see the change, and now it's really quiet, and the things have really settled down. And I mentioned that next year, this year, we will see a lot of positive development in terms of the government to get things. We start doing things with the new administration, right. And also with the potential opening of the border, and that will help Hong Kong. Right, that's the catalyst. Right. That's one thing. And the other thing, don't forget that last year, we can't look at Hong Kong on the index itself. It's kind of unfortunate that if we look at the one negative sector in Hong Kong is very interesting. If you look at the SOEs listed in Hong Kong, I mean, there are quite a lot of SOE companies which generally investors don't like them. I don't know why. They are really low valuation, but last year, they actually went up. A lot of those companies went up 20 to 40%. Okay? But the index was
Who are the
down
major
big.
investors buying those stocks, though, and then made them had
And
about?
they were really cheap, right? They were really cheap. They were so cheap that after they go up 20%, and their earnings
Everyone
grow
came
even
in, yeah.
more, and now they're cheaper, right? And so there, I mean, cheap is really, really important. Another point I kept mentioning was if you look at Russia, right? We know that Russia and the U.S. are in some kind of trouble right now, and over Ukraine. And China was Russia was in a bigger trouble back in 2014 when they invaded, or you call it, they entered Crimea. I don't want to take a point, right? I don't want to take a side, right? And so whatever you call it, and Russia was sanctioned. But from 2014 to 2018, the Russia stocks doubled, with almost zero growth in the economy, right?
Those are still different. Those are, I think, they're comparable. They're not very comparable. Can we talk about the green energy stocks? Yeah. What's your view on the green energy stocks and its relative valuation?
When you get the stocks really, really cheap, and then you don't get a lot to push it higher. And Hong Kong actually has more behind it than Russia back in 2014, right? As I mentioned, there are quite a lot of positive development, which we can see.
Right. Let's go back to the green energy stocks on Asian market. The country is undergoing a green transition. There are a lot of supporting policies on the green energy companies, and the valuation is also very rich on the Asian market, which is similar to what is happening on the U.S. market in the tech sector. The valuation, the PE, is about 100 times high. So, what's your take on that sector, on Asian market?
The carbon is definitely something we pay a lot of attention to, and we actually caught it quite well back in 2020. In October 2020, when China signed the comprehensive agreement in investment with Europe, China agreed on the 30-60, right? The carbon 30 climax and 2060 carbon neutral. And when China jumped on the bandwagon, and it's clear that the whole world is jumping on that one. But at that point, there was a little bit uncertainty about whether the U.S. would jump on it because Trump was still the president. And then once it became clear and Biden was going to win, or Biden won the election, and of course, all three major economies which were on it. And that's why we saw 2021 was a very good year for the clean energy, for the carbon-related companies. However, I do think the valuation might be too rich in the environment when the interest rates are going higher, and we got to be careful. I think the long-term perspectives are good, but growth is not everything. Valuation is another thing which can change very quickly, right? And we actually have seen that this sector tanked quite a bit over the last few months in China. Right? It was doing really, really well until third quarter last year, and since start turning, and then you have some companies which have lost quite 25% to 30%, some high-flying stocks. And I don't doubt they're not fundamental. I think they are good. But we've got to be careful in terms of which stock we buy, and then whether that valuation was too rich for its potential growth.
Right.
And also here, I think there's another factor which might be more disruptive when the stock started going the other way. I mean, when stock started struggling. Given the cheap money, we saw quite a big development in the quant fund.
Right.
And the quant fund tend to be momentum driven. Right? So when the market's going up, quant fund keeps chasing the momentum up.
Right.
But if the stock start turning, then the quant fund may start chasing stock down, and that might be something investors need to consider.
Right. What's your take on the commodity price in 2022?
Commodity price, I think there's it'd be more initially it'd be still be very positive. I think it's there's a still major support for the commodity because assuming that we don't see another new variant of virus which is really bad and locks down every country, right? Assuming Omicron is the worst that we got, and then the economy will gradually open up and the demand will pick up, and the supply is very constrained on the commodity side, whether it's oil, whether it's a precious metal, I'm sorry, not precious metal, whether the base metal like copper, aluminum, the inventories are all very low, right? So that's very supportive to those commodities. And then on the green side, on the agricultural products, we are the second year of La Nina, and that tend to cut the green production. So the commodity price right now has a tailwind behind it, so we are constructive on almost all of them. But as time goes by, we are more constructive on the base metal, especially the copper, the aluminum, this complex, because the new energy demands a lot of those commodities.
Right.
And we term it you have the new emerging market, you have new energy vehicles which demand a lot of that. You have the solar frames which demand a lot of aluminum and copper. The offshore wind farms which demand a lot of copper. And so the demand side are very strong. And the supply side is really limited on those things. But in the longer term, the demand for oil for carbon energy will gradually be reduced, right? And so we are less optimistic in the medium to long term for carbon producing commodities like oil, coal, and more constructive on clean energy demand driven commodities like copper, aluminum, nickel, those things.
Right. Okay. So my last question to you is a very important one. What's your outlook of U.S. and China relationship in 2022?
I think that actually it's going to improve. I mean, the long-term competition will be there, but keep in mind that the U.S. hasn't mentioned adversary for quite a while, right? When Biden administration came in, they talked about cooperation, competition, and adversary. Now they haven't talked about adversary for a while. They talk about responsive competition. And China talks about benign competition. Right? And that's one thing, and from just the way they talk. And the other thing is that I think this year, each country will focus on its own politics. And China has the economy to deal with, and the US has the election to deal with, the midterm election. The midterm election, the key problem for the Democrats is actually the inflation. They can't complain inflation on China. If they have a job market problem, they can complain about China, say Chinese took our jobs. But if the inflation, actually they need to work with China to cut tariffs to reduce that inflation. So I don't see China becomes a major election issue. So that's why I think the relationship is going to improve. And the one data point is that I actually check the real clear politics. I read those pages almost every day. And every day I got in there. The first thing I do is a search China. And nowadays, on the front page, a lot of days you don't see China at all mentioned in the real clear politics. That's the gap of a lot of articles there, right? And second, China is fading gradually from the U.S. headlines. I think that will that means that there will be improvement in the relationship between the two.
Great, thank you very much. And then that is Dr. Gao Bing, our special guest today for our 2022 Economic Prospects special series. There are a lot of challenges while we marching into 2022, but also a lot of opportunities. Tomorrow, we are going to continue our series dialogue with Charles Lee, who is the former chief executive of Hong Kong Stock Exchange, and he is also now the co-founder of MicroConnect, a company dedicated to small to medium-sized enterprises financing. So we're going to hear his insight tomorrow on capital markets and also economic outlook. Stay tuned.